But Pankaj Murarka is now joining us. He's CEO and CIO at Renaissance Investment Managers. Pankaj, good morning. Good to have you with us here on the program. Thanks very much. So tell us, Pankaj, what is on your radar? Five themes or five, even better, stocks which are on your radar after the run-up we've had, which has been pretty powerful from off the lows. Things happen in double quick time. There's hardly any, you fall fast and you come back faster. It almost seems like did the fall actually happen in the first place? For many of these names, it appears like that. Your thoughts and what are you focused on now?
Absolutely, Prashant. I absolutely agree with you. It's very difficult to keep pace with this market. So rather, I think for longer-term investors like us, it's more of the approach is more of avoid the short-term volatility and noise and focus slightly more on medium-term, long-term. The whole risk-off trade which happened in the world post the announcement of tariffs and then retreat by US in such a short period of time. And that has led to a risk on, and meaning life has come a full circle in that sense. I think one thing that clearly stands out in all of this volatility is India, I think, and there's a greater acknowledgement of that India is a Goldilocks economy, I would say. Because even during the peak of the tariff noise or risk, I think there's a clear acknowledgement of the fact that India probably will be the least impacted. Having said that, I think from an investment point of view, we need to concede that markets are fully priced. I think we eventually, India is the most expensive equity market in the world, and markets are fairly priced. Markets are already pricing in earnings over the next 12 or 18 months. So in that sense, obviously, there's no apparent value left on the table. I think, and from our point of view, my view is that returns from here on will be more in line with earnings growth. And we need to bear in mind that we're coming out of a cyclical slowdown in the economy. Last year, FY25, earnings growth at the index Nifty 50 level has been about 5%, probably the slowest earnings growth that we've seen in the last 5 years. Probably we'll see earnings uptake, but I still think it will be a modest, low double-digit earnings growth going into the next year. So for us, it's more about finding or identifying pockets where earnings growth can be somewhat higher than the aggregate index earnings growth. And as we've discussed in the past, I think two pockets where I see earnings growth surprising positively is one, banks, and within that private sector bank, the larger banks like HDFC Bank and Kotak Bank, which are coming out of a sharp earnings slowdown. And the second is the consumer as a sector, because I think consumer as a sector is coming out of a earnings slowdown of almost 3 years or 10, 12 quarters now. And we see all the signs of recovery in earnings growth coming back in consumption, probably both volume growth coming back, and that should drive superior earnings growth than what's already built into the street estimates. Apart from this, I think another pocket probably I would say is IT, because the sector is still down about 10 to 12%. The large cap names are down between 10 to 15% from the peaks that we saw pre the announcement of tariffs. And it's apparent that things are not so bad in the US economy as it was perceived now that there's a retreat on most of the tariff and all of that. So while the hangover might still remain in terms of what happens post the 90 days pause, but I think we should see an uptick in earnings recovery in IT as a sector in the second half of the year. So probably that looks a safe haven. I think those are the broad three sectors that will look like. And then I think after that, it's more about trying to find ideas on a bottom-up basis.
Sure.
One approach we
are Pankaj, let me come in over here. So basically, I'm glad you mentioned this. That was exactly my question. That relatively speaking, which pockets can see better earnings performance? You've named out three: private sector banks, IT, and consumer. Let me take up consumer because that's where market positioning perhaps is the weakest. So that's an area of interest for sure. We were just discussing this, some of the QSR names, the numbers have started looking good after a long time, after many disappointing quarters. So in consumer, what would you play? Till now, it was all about play consumption through a jewelry stock or play consumption through a real estate stock. But how would you look at it now for the next 12 months and beyond?
So we're trying to look at pockets where probably the growth can surprise on the upside. So as you rightly said, in the QSR space, we really like Jubilant Foods because we think there is just to give you a context, the total number of customers having in the organized pizza market in India, consuming pizza through organized chains is about 10 million in India. And we have, just to give you a context, there are about 50 million people trading in stock markets or investing in stock markets. So we think the organized space can grow significantly. The room to grow in the organized space is very significant. And I think there is a strategy reset there in terms of the new approach that the management has taken, where they've made their offerings more value accretive to consumers. And for the last 3 quarters, if you see, they've been getting very strong volume growth, which effectively means they are raking in new consumers. So we're essentially looking for companies which, in an environment where growth really picks up, are doing something extraordinary in their business so as to deliver growth much higher than the industry growth. So in the QSR space, we own Jubilant Foods and we like them in terms of the strategy the management executing. Likewise, we own few companies on the durable side. So again, I think as we see, probably there are a fair bit of tailwinds at the macro level for consumer recovery. One, apart from in the low base, probably the tax cuts which are announced in the budget should start flowing into the pockets of the consumer during this year. And hopefully with good monsoons around, we should see a better second half spending environment for consumers. So that should help some of the durable companies within that space. We own companies like V-Guard and Crompton. And at the same time, after a gap of almost 5 years, I'm equally positive on staples companies because the volume growth for staples has been pretty low. So, but within that, we still like companies which are, taking strategic initiatives to accelerate their growth curve by getting into new categories or penetrating deeper into the existing categories so as to increase their market share. So some of the companies that we own in the space includes likes of Godrej Consumer and Tata Consumer, because these companies have been making significant efforts organically and also through acquisitions to expand their overall TAM, if I may say so, in the context of the new age companies, and accelerate their growth curve. And probably at least the stated management intent is to grow at 2x the industry growth, 1.5 to 2x the industry growth over the medium term to long term. And we clearly see management putting, taking strategic initiatives to drive that growth. So our bias is always to looking for companies which can deliver much higher growth and where management has taken strategic initiatives to drive that growth, because eventually that is what will translate into shareholder returns over medium term to long term. So yeah, these are some of the names that we like in the consumer space.
Okay, all right. Good conversation, good perspective there, Pankaj. But unfortunately, we're a little short on time because of earnings season. But really appreciate you giving us an insight on why you think that consumer is going to start reviving. Look forward to a longer conversation soon. Thank you for joining us this morning.